In the third part of Part 3, Chapter 6, we're going to determine interest rates and we're going to look at how they're determined. So far, we've just looked at the Fisher effect. The nominal rate of interest equals the real rate of interest plus the expected inflation rate. But we have other things to consider. We have risk structure, which includes default risk premium, illiquidity risk premium, tax exemption discount. Now, in the risk structure, default risk is the probability that the issuer of the bond is unable or unwilling to make interest payments or pay off the face value. U.S. Treasury bonds are considered default-free. The default risk premium delta is a spread between the interest rates on bonds with default risk and the interest rates on Treasury bonds, holding other factors constant. Here's a list of various ratings that the S&P and Moody's and Fitch give to various different kinds of bonds. The highest rated bonds are AAA. They're corporations with very good credit ratings, all the way down to D or C rated bonds. And they're called junk bonds, basically. So when you go from a rating such as this down to a rating such as this, the probability of default rises because these are kind of speculative and these are really well-established blue-chip companies. Okay, so this is how the risk structure works. You have a corporate bond market and you have the U.S. Treasury market. U.S. Treasury market is considered risk-free. Maybe as soon as corporate bonds, maybe the first corporation that issued a bond, maybe people kind of assumed that, they won't default, right? So in a kind of initial setting, we're kind of holding everything constant between these two issuers of debt. We're going to say everything's the same in terms of default risk, price, quantity. Everything's identical in this initial state. There is no default risk if you hold a corporate bond. And if that's the case, then the price of the corporate bond would be $950. The price of the U.S. Treasury would be $950. And the yield to maturity would be 5. And then your quantity demanded and supplied would be right here. Now, all of a sudden, people realize that a corporation can go out of business. And if they go out of business, they can't pay their coupon payments or their face value. So once people realize that the demand for corporate bonds is going to fall, right? And so this is the number of people who sell off these corporate bonds once they realize that, oh man, these guys could default. Where do those investors go? Well, they go over to the Treasury market. They go over to the Treasury market. So this number of people equals this number of people. So these people don't want to do what? They don't want to hold a risky asset when they can hold a risk-free asset. So they leave this market and enter this market. Now, not everyone leaves, because as people leave this market, what happens to the price? Well, it gets bid down to $925, right? So, well, at this price, maybe people are willing to take on that probability that this corporation might go out of business. Also, when people are leaving this market over here, the corporate market, and entering the Treasury market, the price gets bid up, and maybe that price gets a little too high, right? $975, right? That's a lot more than $950, and it's a lot more than $925. So at some point, the demand for treasuries is going to kind of stop increasing relative to corporates. Okay, and then the difference in the yields in the treasury yield and the corporate yield, that difference where the corporate yield is 6% and the treasury yield is 4%, that difference is 2 percentage points. The difference in price is $50, right? The difference in price is $50, but the difference in the yields is 2 percentage points. And that 2 percentage points is the default risk premium. Okay, here's an example. You own a $1,000 10% GM bond that matures next year. The Obama administration abrogated 100 years of bankruptcy law when it stripped the primary bondholders of their first claim rights on corporate assets during the GM bailout. Explain why corporate bond prices would be lower in the post-bailout era, holding all else equal. If the GM bond sold for 1068 before the bailout, but sells for 1023, we're going to compute the yields and then use that as a default risk premium. So we can use Excel. The number of periods in both cases is 1. The face value of these bonds is $1,000. The payment is $100 because they're 10% bonds. And then I gave the price as 1068 and 1023. Now when you plug this into Excel, or you can use a TI-83. In a TI-83, you're going to replace what will appear to be an A, or you'll type an A in there, and then you'll hit enter. And in the TI-83, you'll get 2.996 for pre-bailout and 7.527 post-bailout. Now, you could have done this in Excel. Let me show you could have done this in Excel. In Excel, you pull up Excel here, and if you type equal rate, parentheses, the number of period is 1, the payment is $100, the price is a negative 1068 because you got to pay that price in order to get the $100 payment or the $1,000 face value. We hit enter here and we get 3%, add some decimal places, and we get 2.996%. So we can get the same thing in the TI-83, or we can get that same value in Excel. To get this 7.5227, all we got to do is change the price, remember? The price got bid down from 1068 to 1023 because people realized, wow, this administration just erased the primary bondholder rights to the company assets by giving them to the government and the labor union. So you can see that the yield to maturity went up. So the default risk premium is this difference, just under 5 percentage points, about 5 point. Let's just take the difference. My arithmetic is not working very well in my brain today. So let me just go down here, and I'll change this to the original price of 1068, and the default risk premium is 4.531%. Okay. Now, what about the illiquidity risk premium? Liquidity is the relative ease with which an asset can be converted into cash. There's a cost to selling a bond. The number of buyers and sellers in a bond market affects liquidity. If there's a bunch of people looking to buy, liquidity is much higher. The illiquidity risk premium, lambda, is the spread between the interest rates on a bond that is illiquid and the interest rate on a treasury bond, holding a lot of other factors constant. Let's go to our model here again. If default risk premium is identical between corporate and treasury, and corporates are just as liquid as treasury, then, and everything else we can think of is identical, they'll have the same price and the same yield. Okay? But because a corporate bond is much harder to sell than a treasury, because the corporate bond market is much, much smaller than the treasury market, central banks are buying treasuries, sovereign wealth funds are buying treasuries, corporations are buying wealth funds, large and big investors are buying treasuries. The treasury market is just much more liquid. There's more sellers to sell to at any given point in time, so that market tends to be more liquid. Okay? So the demand for corporates are going to be a lot lower relative to the demand for treasuries. And that, again, creates a differential between the yields. So in this example, you're considering owning $2,000 bonds that mature next year. One is a corporate bond, the other is a treasury. And maybe this corporate bond, to control for default risk. Maybe these corporate bonds are really high-grade corporate bonds in terms of really high AAA credit ratings, where people think they're not going to default, right? So that would mean the default risk is the same between the two. So we're not talking about junk bonds here, right? We're talking about AAA corporate bonds relative to Treasury, where maybe there wasn't any history of AAA bonds rated that level ever defaulting in this particular economy, right? So here we're comparing, say, a AAA corporate bond to a Treasury. And the corporate bonds just have many fewer buyers than Treasuries, so they're just going to not be as liquid, right? Both have an 8% coupon rate. Why is the price of Treasuries higher than the corporate bonds with the same attributes, right? Other than the fact that there's just a lot more buyers of Treasuries. So in this case, we do the same thing as we did before. There's one period. The face value is $1,000. Now the coupon rate is 8% of 1,000, so the payments are $80. The two have different prices, and then in Excel you would type an A here. I mean TI-83 calculator, you type an A here, and then you would hit enter, and you would get 2.079 and 7.892. In Excel, all we got to do is change the payment to 80 and this price to, I don't know, 58, and then hit enter, and we get 2.079, right? And then over here we got to change this to 80, and then we got to change this price to 1,001. And oh man, I messed this up. Let me move this around like this. I'll take the difference of them now. The difference in the two is 5.813%. Now the reason why that is because we have a AAA bond over here, AAA corporate bond over here, and we got a Treasury over here. Relatively speaking, they got about the same level of default risk, right? AAA corporations aren't really going to go anywhere, especially if they have defense contracts. Treasury bonds aren't going to go anywhere, so there's really maybe very little difference in these two kinds of bonds when it comes to default risk. But because corporate bonds have much fewer buyers, they're not going to be as liquid as Treasuries. So the difference in these two, a corporate AAA and a Treasury, that difference is going to be mostly due to illiquidity risk. Now, what about tax-exempt discount? Municipal bonds issued by cities, are tax-free. So for that reason, investors tend to want to hold them because the coupon payments and the future, those things are tax-free. So in the absence, if we assume that these are really well-run municipals or cities, and this is Treasury, maybe the default risk is the same for both, right? And if every other attribute except for the tax exemption are identical, then they're going to start at the same spot with a price of $950 and a yield to maturity of 5%. But because if the government all of a sudden changes its tax policy, where it introduces an income tax, right, and that income tax applies to coupon payments on Treasury bonds, but it does not apply to municipal bond coupon payments, then for tax reasons, people are going to leave the municipals or the Treasuries market and enter the municipal market. And that creates a differential between municipals and Treasuries. And that difference is called the tax exemption discount. And here's an example. You're considering owning two bonds, $1,000 bonds that mature next year. One's a corporate bond, the other is a tax-free municipal. Maybe this is a AAA corporate bond, right? And the municipal is, instead of Treasury, we'll do AAA corporate, which has a very low default risk. And municipal, and this is a well-run city, so it has a really low default risk. And we'll assume those two default risks are the same. And one is a $1,000 bond, the other is a $1,000 bond. They both have an 8% coupon. if the bonds have a current yield of 3.5%, and you intend to hold them for their final year, compute the price you would be willing to pay, assuming a federal income tax of 50%. So for the tax-free municipal one and the AAA corporate bond, where the default risks are about the same, and the face values are the same, $1,000, the tax-free municipal coupon payment would be $80, right? Because it's tax-free, and 80% of $1,000 is $80. The corporate bond, though, after tax, this is after tax. There's no tax on tax-free, so you get the whole coupon. The payment after tax on the corporate is only $40 because there's a 50% tax on the coupon payments of a corporate bond. If there wasn't a corporate tax, this would be $80. But because the tax rate is 50%, you have to pay $40 in tax, and 80 minus 40 is 40. So your after-tax payment is only $40. And in this particular case, we're assuming they both have a yield to maturity of 3.5%, and then we put the A into the present value of the T83, we hit enter, and we get the price of the corporate bond at $1,004, and the price of the tax-free municipal at $1,043. So people are willing to pay a little higher price for that municipal bond. And we can calculate that in Excel up here. We'll take the, this is the higher price bond, so the payment is $80 because it's tax-free, and this is $1,040, 3.48. Hit enter. 3.5% there, right? And this is 1,004.83, and this should be 3.5%. See that? Whoops. Oh, we forgot to take the tax off. So we have to pay a tax of $40, right? If we take a tax of $40, that yield to maturity drops to 3.5%. Now, because these are present value calculations, let's do it this way. Instead of recalculating the yield to maturity, we can calculate the price by using the present value function. The rate is 3.5%. The number of periods is 1, because you're only holding it for a period. The payment for the tax-free municipal is $80. We'll make it minus, or $80, right? And then, well, we'll make it minus. We gotta start with a negative here. We gotta make that negative. So tax-free, we get $80 payments, and the face value is $1,000, right? $1,043.48. I'm gonna go ahead and drag this down here, and instead of writing 80 here, I'm gonna knock off $40 because we have to pay $40, 50% tax, and the price drops to $1,004.83. So in this case, there's the difference in price is substantial, almost $40, because people are willing to pay a little extra for that tax-free municipal. And this is the risk structure of corporate AAA bonds, which are relatively risk-free, and then corporate BAA bonds, which are a little more risky than corporate AAAs. And then the dark green is the U.S. government U.S. government long-term bonds, and the light green is state and local municipal bonds. Okay, what about interest rate determination? So we've figured out, or we've been looking at the Fisher effect, the real rate of interest plus expected inflation. We added in a default risk premium, we added in a illiquidity risk premium, and we subtracted off the tax-exempt discount. Now we got to look at the term structure, and the term structure is the maturity premium and the liquidity premium. So the term structure, time matters, right? So far we kind of kept our numerical examples with 1-year maturities, right? Most of our examples have been 1-year maturities. But the longer we lock away our money in a bond, the higher the yield we're going to want because of a thing called inflation. If inflation starts accelerating, then those future payments are going to be worth much, much less. The buying power of those future payments is going to go down dramatically. So we have to account for how long we lock our money up. We have to account for this maturity. Okay. And the term structure is represented graphically by a yield curve. And the yield curve is very important. It tells us if we expect the economy to expand. It can also tell us if the economy is going to go in a recession. And here's the term structure. So we have a 20-year bond, right? We have 3-month bills, and we have 3 to 5 year averages, right? So what we notice here is that down here in 2010, the 3-month bills had a really low interest rate. 3 to 5 years had a higher interest rate, and the 20 years had a much higher interest rate. So the yield curve is very steep here. But during the recession, the 3-month was as high as the 20-year. So you can think of that as a flat or inverted yield curve, right? And generally what you see is during expansions, the yield curve slopes up. The green is less than the blue, and the blue is less than the red. That's generally the case from 1980 on, right? Green less than blue, less than red. So as maturity increases, interest rates rise. As maturity increases, interest rates rise. So that's a pretty fundamental relationship in the term structure of interest rates. Okay, so let's just go to the yield curve. Here, this blue yield curve is what it was on Thursday, and this was what it was a month previously, and this is what it was a year before that Thursday. So this is Thursday 2005, right? And this is January 2000. This is February 2005. This is January 2005, and this is February 2004. And what's happening to the yield curve? It was really steep in 2004, but then it's kind of flattening in 2005. So it's flattening. And then in 2008, we had the financial crisis, right? And recession. Okay, so this is a steep upward sloping yield curve, and that indicates that a robust recovery is underway. And then as it flattens and inverts, we end up in a recession. This is my, if you want to read this article, I can share this article with you, but this is what I call the dynamic yield curve. And what it shows is not just the yield curve, but it includes an additional interest rate, the interest rate that the Fed picks and sets. And the red line is the federal funds rate. And you can see that when the Fed starts raising the federal funds rate, it squeezes all these other yields together up to the 20-year and the 10-year. And then when, after it does that, a recession usually happens. And then to stimulate the economy out of recession, the Fed pulls the interest rates apart. And so this graph kind of indicates that maybe the Fed is the thing that is squeezing interest rates, causing a recession. And then to counter the effects of the recession, it is pulling the interest rates apart to steepen the yield curve. And the yield curve here is, the yield curve here is very steep, right? And the yield curve here is very steep. So after the recession, the yield curve steepens, right? Is that because the Fed is pulling interest rates apart and then squeezing them? If you want to read more about that, you can read my article here, and I can share it with you if you want to email me. Here, the yield curve is very flat, right? You have a very flat yield curve. And you have an inverted yield curve there, right? You have an inverted yield curve there. Okay, so the term structure, the term structure under expectations theory says that an N-year bond has a current yield equal to what you would get from 1-year bonds. So this is the actual 1-year bond yield today. And if you held that bond for 1 year, you'd get this. And then once this matured, you'd buy another 1-year bond, and you'd hold this for a year. This is what you expect that yield to be. And then after this bond matures, after 1 year of holding it, then you'd buy another 1-year bond. So this is all of these, but that are what we expect 1-year yields to be in 1 year, 2 years, yada, 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 and minus 1 years from now. So these are what we expect these 1-year bond yields to be, and the yield on an N-year bond is just the average of those. Okay, and the maturity premium is the difference between this average and that yield in that very first year. So the maturity premium is just the difference between this average and that first value. Okay. And this is kind of how it works. Now again, this is what the 1-year yield is right now. This is what we expect the 1-year yield to be in 2 years. This is what we expect it to be in 3 years. This is what we expect that 1-year yield to be in 3 years. This is what we expect that 1-year yield to be in 4 years. And this is what we expect that 1-year yield to be in 5 years. And the way it works is, and these are all expectations, right? The only one that is not an expectation is what it is right now, right? So these are all expected yields from, say, a futures market. So the way that this works is, well, the yield obviously for the a 1-year bond is the 1-year bond rate, right? So it's just the average of itself, right? Now for a 2-year bond, you take an average, what it is today, and what you expect that 1-year bond rate to be in a year, and you take the average, and you get. So this is the yield to maturity for a 1-year bond, and this is the yield to maturity for a 2-year bond under expectations theory. And then you just average the next 3, average the next 4, average the next 5, and average all 6 of them, right? Okay, so this makes sense. Why does it make sense? Because if I plan to lock my money away for a year, I'll make 1.08, right? But I got 2 ways to lock my money away for 2 years. I can buy a 1-year bond, and then when it matures, I can buy another 1-year bond. So I'm going to get 108 the first year, I'm going to get 1.738 the second year. Or I can just buy a 2-year bond. And so under expectations theory, the 2-year bond yield is just the average of these two. If you want to lock your money away for 3 years, what you can do is you can buy a 1-year bond at this yield. When it matures, you buy a 1-year bond at this yield, this expectation. And when that matures, you buy another 1-year bond at this expectation. You can do a series of 1-year bonds for 3 years, or you can just buy a 3-year bond. And this is the average of those 3, right? So this is buying a 3-year bond today, or buying a 1-year bond, and then buying a 1-year bond, and then buying a 1-year bond, and holding each one of those bonds for the entire year. Right? Yada, 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 right? So in the 6th year, if you want to lock your money away for 6 years, you can buy a series of 6-year bonds, 6-year 1-year bonds. You can buy 6 1-year bonds, one after the other, right? Or you can buy a 6-year bond. And this is the average of those 6 1-year bonds, right? So that it's intuitive. It makes sense. And this is the yield curve using expectations theory. Okay? And the maturity premium is, like I said, that 1-year bond rate minus the 2-year bond rate. So this is the 2-year bond rate, the 3-year bond rate, the 4-year bond rate, the 5-year bond rate, and 6-year bond rate. The maturity premiums are just the differences in those, right? And notice that it goes up, right? So that's expectations theory. Now, in liquidity premium theory, bonds of different maturities are partial, not perfect substitutes. So the problem with expectations theory is this. These might be the expected yields in the future, but in a year it could be 1.8 or 1.5. In 2 years this could be 1.5 or 4.8, right? So these are just expectations. And because the further into the future you get, the worse the expectation or the prediction. So this might be a pretty good prediction here, but this might be way off because that's 5 years into the future. 5 years in the future, this could be anywhere from like 30 to 0.25, whereas this might be 1.9 to 1.5. So these predictions are better closer to the current period. So you need to add in what we call liquidity premium, right? You need to add in the liquidity premium. And so the next part is the liquidity premium. Okay, so the liquidity premium might be given by this equation here, something simple to understand. And so all we have to do here is we got to plug in 1 there, multiply that by 0.08, and we get a liquidity premium. And then we just add the liquidity premium to the value that we had from expectations theory. So this is expectations theory yield curve. This is our liquidity premium, and this is the yield curve under liquidity premium theory. Okay, so we just double that value because we plugged 2 into there, and so our yield curve is actually steeper. It's actually steeper because we got to kind of play it safe, right? We got to play it safe. The further we get into the future, the more safe we got to play it. So this liquidity premium is kind of playing it safe because the further into the future, the worse the predictions are. Okay, so when we add in the liquidity premium, we get a much different looking yield curve, right? So this is expectations theory yield curve plus this liquidity premium, and together they are liquidity premium theory. Okay, so before this section, all we had was the nominal rate of interest equal the real rate of interest plus expected inflation. That's the Fisher effect. We might have some default risk. We got to add that in. We got to add in some illiquidity risk. We have to maybe subtract off a tax exemption discount if the instrument has tax-free coupon payments. We have to add in maturity premium. So up to this point, we're talking about maybe 1-year bonds, right? But we might be talking about 10-year bond. So we have to add in a maturity premium. And we also got to add in a liquidity premium. And these two together are called the term structure.